Well, thank you and good afternoon. My name is Matthew Britten. I'm a partner and managing director with PwC here in Bermuda. I have responsibility for serving our insurance and reinsurance clients from both an advisory and an assurance perspective. I'd like to obviously start off by thanking our three expert panelists for agreeing to share their perspectives today. And by way of introduction, we have, to my immediate left, we have Perez, who is the CEO and founder of Horseshoe Group, Jeff Sangster, who is the Chief Financial Officer of Validus Holdings, and Chris Schaper, who is the President of Montpelier Re Limited. So thank you for joining us today. The objective of this session is to talk about how a number of key market forces are expected to guide the future landscape of reinsurance. However, I would like to start briefly by focusing on the present and ask the panel whether today's market conditions, which are underpinned by continued low interest rates, a difficult pricing environment, the influx of alternative capital, changing regulation, and reputational issues over tax, which is a plethora of current market conditions, whether you believe that these market conditions are already driving significant change and innovation and evolution in the reinsurance industry. Andre, could I start with yourself?
Yeah, sure. I mean, that's a pretty tall order. Which one do I pick?
I didn't want to lowball it.
All right, I'm going to start with my favorite, which is the alternative market. Of course, that's what I do for a living, which is the whole ILS spectrum. But you know, innovation really, I mean, we talk about innovation, but innovation is not new to this market. I mean, we've had innovation throughout the years. For those of you that are old enough to remember, you know, finite reinsurance, which is now a no-no word. We call it structured reinsurance. It's a much better word. You know, there's a continuous trend of innovation. What is different in today's market, at least from the alternative capital, is the speed at which that capital is coming in. And more specifically, really for short tail lines of business, and we'll talk about what the future holds eventually. But the speed at which this, you know, if you think on the property cat side, you know, you had recent statistics saying that about 15% of the worldwide cat premium is now ILS or insurance-linked security, whether it be cat bond or collateralized reinsurance. And we could see that trend growing pretty fast. So from that perspective, what is changing, some of the reinsurers, unfortunately not all reinsurers have, you know, faced the music and read the memo. But I think eventually people are going to have to react and rethink their business model. So that to me is one of the major drive at the moment on the reinsurance side. Obviously, when you talk about regulation, whether it be Solvency II, whenever Solvency II will get implemented, hopefully I'll be retired by then. You know, but it's always the natural barrier to innovation, right? Is regulation. And any sort of new accounting standards or reporting. So it's trying to work within the confines of you know, increased regulation, or I would call it more burdensome regulation, which, you know, quite often loses touch with the reality of the business. And what you could do. Now, without wanting to preach for our parish here, but if you think one of the beauty of Bermuda is that we've always fostered innovation. We've always made innovation possible and simpler. And that I think is going to continue being one of our major strengths here.
Maybe in the same vein to either Chris or to Jeff. Andre brings up the point that ILS is something that is a hot topic at the moment, something that we're talking about a lot. Do you think when we reflect back on history, this will be ILS and the convergence will be something that this point in time will be remembered for, or will other factors from the current market conditions also play into how we view this point in time?
Yeah, no, I think clearly we're at an inflection point right now. You know, the ILS market is moving forward. that train is coming, and traditional reinsurers have to make a decision whether they're going to be on the train or find themselves in front of the train on the tracks, and so obviously of all the things you mentioned at the outset, that's the biggest factor in what's changing the market right now. Not to diminish the other items, but clearly ILS is the item that's really driving the change in the market. I think we are going to look back in 5 years and see that this point in the market was a critical shift, as the market really continues to try and find its feet in that balance between what is the appropriate mix of traditional reinsurance and more innovative products coming out of ILS in a client's program. What's the appropriate mix for traditional reinsurers in terms of their capital or balance sheet based side of their business versus more of a fee-based side of the business, managing other people's money. Virtually everybody's in that game now from the traditional side. Some sooner than others, but that's everybody's kind of trying to find their place in that market. And I think the market itself is really in limbo. There hasn't been a big loss since the real growth to the 15% of the market being ILS, and so that hasn't been tested. It's been a low rate environment since ILS has evolved. And so a change in rates is yet to be seen what impact on the market that is. So I think what's interesting is that previous points and kind of game-changing points in the market have been as a result of events. If you think about '92 or 2001 or 2005, whereas this inflection point is a bit more of kind of an organic change. Where it's the market itself that has really evolved, and so in a lot of ways, it is probably one of the most innovative. It's not reactionary. It's almost more proactive change in the market to more interesting products that suit the buyer's needs. More so than the traditional market, and as I said, finding that balance is going to be interesting as that plays out.
It surely will. Maybe we can shift gears a little bit now and move squarely towards.
I wanted to respond actually.
Oh, sorry, sorry,
Well,
Chris, I apologize.
I think I do think it's very interesting what's going on right now. And to me, this is an issue of capital, and I think the watershed issue is the awareness of capital throughout the industry. Whether it's on the insurance side, the reinsurance side, within the different areas of Wall Street, et cetera. It's all about this very distinct awareness of it. And you brought up many, many issues that all have a play on capital. And so we're all thinking about this now. I think the industry is actually much smarter than it ever was in the past. And that's what's really driving the change. It's intelligence that's actually driving the change, and the ability to have options in terms of the utilization of capital. I think that's really the key issue right now. If we were going to look back on this time period, that's what I think is core. So,
apologies
to your
for
other
giving
point.
the speaking point. I'll let you go first with the next one.
Okay.
In thinking about the future a little bit more holistically, I'd like to start by discussing how maybe customer expectations and distribution may actually shape the future. And Chris, we've seen a trend in the primary insurers retaining more risk, but how broadly have customer expectations been changing, and how do you see that impacting the reinsurance market in the future?
Yeah, I mean, they've been changing quite a bit, very, very dramatically, actually. And I think, the firms that are able to actually provide clients with options, again, are the ones that are going to win out. The clients are looking for not just, everyone's looking for better prices, right? I mean, particularly from a reinsurance point of view. Reinsurance is a very significant expense that all insurance companies have, and they're always looking to diminish their expense. And there's only so many ways you can make money within a company. One way is to manage your expenses. So given reinsurance being such a large percentage of that, if we can actually reduce price, there's a lot of value there. So everyone's looking for that. But what they're also looking for now is insight into their own business. So we talk about analytics. I think this whole issue of analytics is pretty fascinating. It's about data. Data is a raw material. It's very important that, if you're going to be in the capital space, you're actually thinking about the varying raw materials that actually come together. And clients are definitely looking for us to look at their information, provide them feedback, talk to them about where we see gaps, talk to them about how to think through risk differently. Now, the models that exist in today's world, probably many of them can be thrown out, and over time they will be. But for now, these are what the industry use. The clients are actually, they're very aware that the models don't necessarily show them and provide them the distinct knowledge that they need. And so it's really up to the reinsurers or others in the market to provide this type of intelligence. So price, analytics, the use of their capital, which incorporates structure, trying to think through different ways for them to contemplate loss. I mean, for many companies, actually having more than just an annualized transaction has a lot of value, right? But for a reinsurer, it's actually pretty difficult to put capital to work for that period of time. So there's a need to try to figure out the blending of some of those issues associated with structure. And that's another area that actually we need to continue to focus on. And that's happening more and more and more. So clients, yeah, I mean, and whether these are corporations regardless of their size, these are corporations, they're looking for the insurer to provide this type of feedback. If these are insurance companies, they're looking for the reinsurers to provide this type of feedback. And if it's reinsurers, we're actually open to any kind of suggestion that we can get, because in many ways we're trying to organize ourselves to connect with outside parties, right? So whether those outside parties are universities or different educational or academic individuals who are associated with capital use, et cetera, we're trying to reach out and find different avenues for knowledge, right? So it's a full circle.
To that end, Chris, is there, reinsurers typically tend to be one step removed from their customers because of the broker world. Is there a need or a desire for the traditional reinsurers to get closer to their customers and get that next level of data that you're referring to?
I feel that way, yeah. I think our ability to get close to clients is extremely important. Every reinsurer will talk to you about the importance of the client and getting close to them. The client themselves, when you talk to an insurance enterprise, depending on who they're insuring, if they're insuring large commercial transactions, they're going to be somewhat leery about you getting too close to them. But if you can provide, again, insight that they could not otherwise provide, they're happy to go along with that. And from a reinsurance point of view, I would just say that whether the client is the broker, whether the client is the insurer, or whether the client is the client of the insurer, all of them are looking for further knowledge from us. And if we can get closer to them, we should be trying to do that every day.
I mean, it's interesting because you talk about getting closer to the clients, right? And I'd almost distinguish between insurance and reinsurance. If you think from a reinsurance perspective, I know you haven't asked me the question, but if you don't mind, I'm just going to jump in.
More than welcome.
This is supposed to be interactive, right, guys?
It is.
Okay, good. I'm just checking.
It's 2013, yeah.
And the thing is, when you look at the relationship between insurers and reinsurers, obviously the counterparties are both sophisticated counterparties. So I think you're dealing with a different mindset than on the insurance side. What's really interesting, and so the whole interaction and sort of the data mining or creative solution between insurer and reinsurer, yes, it's happening more, but it's no different. It's just a natural evolution of getting to know more about their data. What's really interesting is the trend on the insurance side, right? And I know we'll talk about emerging markets later on, but if you look at an example which recently happened, right? You look at the New York Metro, Transportation Authority, whatever they're called, MTA. So you look at their cat bond, right? Metro Cat, which I thought was really interesting because it's basically bypassing, right, both the insurer and the reinsurer and accessing directly the capital markets. Right? And if I have a prediction to make, I would say the large corporates are going to start thinking outside the box and say, you know what, you're accessing capital markets, I can access capital markets too. And by the way, I have a captive. I thought one of the use of my captive was to access reinsurance. Well, now one of the use of my captive is to actually access capital market. Again, I think we need to be aware of that trend, where, especially for the large corporates, right? Because those guys are going to look at their entire program and say, okay, well, where does it make sense for me to pass some of the risk to my insurers directly, some of the risk to my reinsurers via my captive, and some of the risk, via the capital market?
Yeah, I definitely agree. I definitely agree with that. Large corporates will have that capability.
Right.
They have the sophistication to do it. And just to comment on the MTA, I mean, the MTA actually came to the market first, right? They came to the traditional insurance market first to try to get their placement done. Couldn't get the placement done. So the subsequent result was going to the capital markets and getting it done.
Yeah, the question with those big corporates that are looking to do it on their own is, to Chris's point, where are they getting the information and to be able to do that themselves? Who do they look to in the absence of an insurer or a reinsurer for the knowledge that you need to put together your own program? Obviously, brokers are going to play a role there, but we see 90% of the cat limit placed in the world every year. So as kind of to build on Chris's point, we as reinsurers have a unique position of being able to provide that information, and potentially the danger in kind of going straight to the capital markets and skipping the insurers and the reinsurers is there's also a level of knowledge and information that's being bypassed there as well.
Great, thank you. Can we now talk a little bit about distribution? This year has seen some interesting arrangements and alliances. One of those, the Willis 360 program that I think Kevin mentioned in the previous session. How does the panel feel that those new arrangements and alliances will impact, obviously they're directly at the insurance market at the moment, but ultimately the reinsurance market? Do you see any trends there in how distribution is working with reinsurers?
Are you referring to the Aon Berkshire?
And Willis 360. These are big deals.
All right, I'm not an underwriter, and I'm not politically correct, so I'll tell you what I think. I always think it's a great idea to give the pen to a broker, isn't it? I mean, that's usually the recipe for success. I'm joking, guys. I'm joking. So that's my opinion. To a certain extent, what's really interesting is that you're sort of becoming, creating what financial people will call a beta, right? So you're following the market without any sort of differentiation, which is fine if that's what you want to create and you have a lot of money and you figured, well, I've identified a book and they have privileged access to it. For those of you that are old enough will remember some of the binding facilities we've had in Bermuda, which ended up in tears. And again, I'm not saying Aon is not going to do a good job. It's an interesting strategy in terms of asset deployment from Berkshire. But to a certain extent, it's a binding facility, right? So as with every binding facility, how much parameters, control, underwriting discipline you have around it, I have my own opinion. I know I wouldn't buy it, but
I think your last point, underwriting. It comes back to underwriting and the ability to underwrite. One of the participants in the Willis facility has stated that they still have the ability to underwrite each risk. And if that's a case, then you can see how that works from the perspective of the participants. If you're completely giving your pen away and just absolutely taking an index of the market, we believe in the Lloyd's market or any other market that we can out-select. And selecting risks is important to what we do. If I guess, and if you didn't believe that, why you're here? If you're just completely giving that pen away to take an index, I guess if your objective is float and nothing else, then you can rationalize that. But if you take it to an extreme and nobody's underwriting, that market is only going to end in one place, and it's not going to be pretty.
So as an underwriter,
Go for it.
I think you both have said it actually pretty well. I think in the end, we do know that profit comes from underwriting properly, right? So if that's not part of the recipe, then there will be problems. That being said, probably no time in our history do we have so many options in terms of taking in risk and finding different ways to distribute it, right? So a lot of times when you think about these facilities, you think about it comes in, it gets underwritten to a degree, whatever that might mean, it goes onto a balance sheet and there it sits. Well, that's not necessarily the case, right? Many times it comes onto a balance sheet and then whoever's balance sheet it's sitting on is trying to figure out, well, is there a way to distribute this ourselves? I don't mean that in a bad way, I just mean that there are other avenues to take. So you need to think about the full cycle that actually occurs during any particular circumstance. Now Berkshire will pretty much keep that net, right? But for Berkshire, they can keep it net. It's almost impossible to blow that company up, right? But for everybody else, there is a need to kind of think through what these type of setups may produce for you. If you have the ability to actually underwrite the risk and you're able to access risk that you would not otherwise be able to access and or increase your participation on business that you would like to, then it's something to think about. And then you need to think about the next step, if in fact you want to keep that or if you want to distribute it. So I think there are a number of things just to think about relative to it.
That's a good point.
And perhaps now we could turn our attention to governments and regulation. With a lot of financial resources under strain, can governments who cover a significant amount of windstorm, flood and terrorism risk, can they sustain the current level of direct intervention that they have? And probably a lead on from that is how can reinsurers best partner with governments to help them through that phase?
No, they can't. There's just too much risk out there. There's way too much risk that's being taken by governments, and they've been able to kind of get away with it. Now we're seeing more and more activity. If you just look at the Philippines, who's going to take care of the Philippines? There's no one, really nobody in this room in particular. They're underinsured. You can say what you want to say about that area of the world. It is developing, but they're going to be stuck with the bill. The government's basically going to be stuck with the bill unless the World Bank or some other facility actually steps in and helps them out. But having uninsured losses like that is very significant. When we look at Japan, the amount of seismic risk that's taken by the Japanese government is massive. Once again, there are other alternatives for this business, and the reinsurance and the insurance industry can provide it. We just need to continue to work with them. I think one of the areas that has been very intriguing is the work that the World Bank has been doing in these areas. The Mexican cat bond that's out there, I think, is a very intriguing component. And companies actually look at that and they say, well, I don't have much Mexican risk, or I don't have enough of it, or I actually don't like the risk that's out there. I prefer the bond. I prefer this type of structure. And so there are firms that are actually participating on that would not otherwise write Mexican risk. So I think there are other avenues, and I think those avenues need to be further engaged from where they are today.
Yeah, I would concur. I'm not going to repeat Keen's comments from the previous panel about TRIA. He's closer to that and heading to Washington to speak about it this week. But a charismatic and intelligent chairman and CEO said recently that NFIP should not exist. Since he signs my check, I'm not going to disagree with him there. But clearly, in a developed market like flood, it's inconceivable that that our market, our industry, couldn't figure out a way to deal with U.S. flood. The data's there. Everything is there to be able to do it. It's just a matter of the U.S. government stepping back out of that and letting the market figure it out. The problem is it's always going to be a bit messy until it gets sorted out. And someone who has had a subsidized premium sitting in a floodplain for 50 years is going to scream loud about that. But at some point, market forces and capitalism have to win out and force them either to pay their fair share or to to protect themselves appropriately from those risks.
Yeah, I mean, I think you're both right for different reasons. But, the truth is, as a general rule, I think government has to really assess, whether it is something that is a temporary patch or a permanent position, right? So if you think in the US, for example, we talked about the National Flood Program or even TRIA, there comes a point, and it's a problem with every governments around the world, is once they get into a program, right, whether they get comfortable with it or they stay in it, and then you start building expectation as a customer that government will be there to bail you out. Well, for one, I think, from a US perspective, I would encourage them to sort of get out of some of the programs. Anyway, they're going to need the money to fund Obamacare. The truth is, look at, NIFILA, for example, which is, for some of you that don't know who NIFILA is in the room, they're the largest ILS fund in the world with $9 billion of assets. They recently made a proposal for the Florida Hurricane Cat Fund to take $1 billion of exposure, right? So there is a solution there, and guess what? That got rejected, right? Which to me is staggering. That here we're coming in the market with let's call it a capital market solution, and yet government just doesn't want to get out of it. And the problem is that you're now creating expectation. So if I'm a Florida citizen and I'm a Florida resident and I'm in a hurricane zone, well, guess what? I know that government is going to bail me out eventually. So why should I be discouraged to build in a hurricane zone or in a floodplain? But at the same time, you look at some initiatives like Citizens, which is Florida's sort of insurer of last resort. And what we've started to see in recent years is the slow depopulation of Citizens. So we've seen a lot of depop companies being set up in Florida, which is encouraging because I think that there's risks that are uninsurable, right? Where government comes in, and that's fine because I don't think we have enough money, as you mentioned, Chris. But there are risks that are clearly, if there's an appetite for either the reinsurance market, the insurance market, or the capital market to take that risk on, so we talked about terrorism, right? Then government should be gracious and just get out of it, right? So, but they don't.
I agree. Well, it's a combination, right? I mean, it's the rational side of it is the issue of citizenry, right? Making sure they're doing the right things for the citizens, et cetera.
Yeah.
The irrational side is the issue of candidacy, right? And making sure that someone's going to get reelected, whether it's you or someone in your party, right? And they both mix, and we've got to try to find some kind of a solution that kind of brings both of those to the table. I think companies, reinsurers that actually, or insurers that are trying to find solutions, it really is the only way for it to happen, because it's definitely not going to be the other way around. It's not going to be where the government's going to say, hey, we need some help, right? And I know, for example, I mean the flood issue, I mean, BEER was trying to, and RAA, they were trying to tackle that a few years ago, right? And so there was a request for information, and it seemed as if the information would definitely come, and it was under the Freedom of Information Act, et cetera, et cetera. We'll get the information, They've got to give it to us, and they never gave it to us, right? And so nothing ever happened, but there was a distinct try to get that, right? We've got to try to continue on that same front, try to bring in, I think, some of these meetings that are taking place to try to get the governments to understand, at least the US government and other governments to understand the value that we're trying to bring to the table is, unfortunately, it's still the first step.
Yeah. Do you believe reinsurers are currently doing enough to think about how they partner with governments and explain?
I think they're trying to do as much as they can. I mean, it's tough. I mean, you're trying to run a business as well.
Sure.
You're trying to source risk throughout the world. You only have so many man hours in a day to try to do all of this, and I guarantee you, it's on every single reinsurers and insurers list of things to do. But it's just tough to kind of get to.
Yeah, I think as an industry, we don't do ourselves any favors sometimes. We've got everybody's out there saying we need to innovate, things need to change, we need to have we need to have new products. But then, the next day they're saying, well, we can't deal with terrorism, and we've got to re-sign TRIA. And so, how do you reconcile those two things? In some cases, when it's coming out of coming from the same person, it's like, okay, are we innovating, and is there and looking for opportunities, or are we going to run from risks that have been held in the public realm for their existence? And I think we need to reconcile those two things and be careful what we say publicly, and hold ourselves to a higher standard as an industry, and really think hard about whether the private market can deal with conventional terrorism, because it feels like we're not doing ourselves any favors by just saying, oh no, we don't want to. Well, okay, the world's changing, and if you're not willing to look at those types of opportunities and just dismiss them out of hand, it's hard to believe that you're really kind of living up to that innovation standard that you're asking others to.
Great. How is the face of regulation, most notably Solvency II and other comparable regulations? How's that shaping the reinsurance industry, and is it forging a positive path forward? How does the panel feel? No one wants to go first.
I think Bermuda's doing a good job of mixing the needs of being compliant with worldwide regulation changes and being commercial about it. So I think I want to put that out there first, that of everywhere that we do business, we think Bermuda's got the best mix, and so I think that's clear. It's a lot of money to comply with Solvency II, for example. Some of the quotes around the money that's been spent in the Lloyd's market alone to comply with Solvency II. A quote that I heard recently was, it's hard to believe that if that $100 million or whatever the number is that the Lloyd's market has spent on complying with Solvency II, it's hard to believe that that money was better spent creating models that, as Chris pointed out earlier, may be obsolete or heading that way, or the one thing we know that they're about them is that they're wrong. If they'd taken that $100 million and put it in the central fund, and the Lloyd's market is that much stronger and that much more well capitalized with a stronger backup, it's hard to believe that that's not a better situation for the underlying insureds than spending this money. And no offense to our hosts, but most of it goes to consultants, and ends up not supporting the market. Essentially it flows out of the market in terms of fees.
Yeah, regulation has never been a big proponent of innovation. Bermuda accepted probably, but it's tough because a lot of regulators out there are just dinosaurs, right? And so they're so embedded with their own processes and compliance and whatnot. You talk to so many regulators around the world, and they're so disconnected from the business realities, right? So what comes out, and I'm not going to throw the baby with the bathwater, because I think that there are things in Solvency II that make a lot of sense, which some people need to think about anyway, right? So that to me is not the bigger problem. The bigger problem is it's the devil's in the detail, and so when you start looking at specific aspects of Solvency II, which may make sense in one jurisdiction, doesn't make sense in another. And for reinsurer, and I always say, and that's the debate I have with the BMA all the time, is I said, at the end of the day, for reinsurers, the ultimate regulator are the rating agencies, right? Because you could be as well regulated as you want, but guess what? If you don't have that at least A- rating or whatever is the S&P equivalent, you just can't operate. So no matter how well you're regulated or not regulated. So we need to be able to balance, what makes sense and not be so close to the trees that we're losing the vision of the forest. And that's never, regulation has never fostered innovation, let's put it that way, right? And I guess to echo Jeff's comment, that's where Bermuda, I think, has shone over the years, is that we shone, whichever. Is the fact that we have been in touch. There's a clear balance between regulation and innovation, but that's not always the case, unfortunately. So I would say that whether reinsurers are going bust in a better or less regulated market, that remains to be seen. Okay. Right? I don't think regulation or more regulation is a guarantee for solvency or against bankruptcies. That's my opinion.
So I guess just to round it off, I mean, I think it's certainly change, and where there's change, there's opportunity. So I think actually from a reinsurance point of view, there could be some opportunities for reinsurers as this moves forward, whenever that is. I mean, it certainly has been delayed quite substantially. The expenses are very exorbitant. There's no doubt about that. If there is a trade-off, I think we've talked about risk not coming out of the governmental hands, if you will. If there's an ability for us to trade solvency and Solvency II, et cetera, and these different type of regulatory changes with access to risk, access to data, I think then that's a fair trade, and we should be talking about that type of interaction between the government and industry.
Great, thank you. Turning our attention a little bit now to emerging markets. Evidently, emerging markets present on the surface a significant opportunity with the growth in the emerging markets, and evidently a need, as I think Chris, you spoke about earlier on, the increase insurance penetration in some of those markets evidently presents an opportunity for reinsurers. However, there's a lot of challenges right now with accessing the markets, with limited data to support pricing and modeling. How viable are the emerging markets to reinsurers at this point in time? And is it a short, medium, or long-term game for many reinsurers?
Well, I think it's a long-term gain. I don't think you're going to be able to get there. You certainly can't get there overnight. I mean, the development of all these economies will take time. I mean, the key issue is the middle class, right? I mean, you need to look at the middle class and the development of the middle class in these particular economies, because the middle class, that is what will drive the need for insurance and reinsurance. And when you think about that, you need to think about the different products that they're going to need. And so some very classic products would be homeowners and auto and life. And I think if you talk to individuals, for example, in the Middle East, they would actually speak more towards the life side and what's going on in the life area. And that's a risk. We talk here quite a bit about P&C, but there's this whole other area of our business that we don't actually talk too much about. It is part of the ILS market, but we spend a lot of time, again, just talking about P&C. I think another area to think about there is surety. And the reason surety is an important area is because there's a lot of construction going on in these emerging economies. And they do require protection in the event of default of a contract or a project you can't get done. So, there's certainly areas for us to think about. I think trying to target certain areas is really kind of the proper thing for us to do. But it is going to be a long-term proposition. This isn't something that happens overnight. Right now, a lot of, if you look at portfolios, many portfolios actually get their emerging risk into them through their writings of political risk. Not through the writings of natural catastrophe exposures. It's usually through the political risk type of structure that's coming through that you actually fill up your portfolio, so to speak. I wouldn't say fill it up, but actually get risk in areas you would not otherwise write. So if you look at most portfolios, in terms of Nat Cat, roughly 30 to 40 countries are part of a Nat Cat portfolio. And in terms of countries and provinces globally, there's about 250, right? So the vast majority of them actually don't exist in companies' portfolios. So there are different ways to get that risk, and to construct a strong portfolio with the proper use of capital, thinking through how to get access to them is very important. So, but it is a long-term proposition. It's not something that'll happen overnight.
Yeah, obviously there's massive opportunity there, and anybody who's not watching it, I think it's probably redundant to say, but everybody's watching it. But it is, agree, it's a long-term proposition. Insurance and reinsurance is a trailing indicator of development, not a leading indicator. You've got to have stuff before you insure stuff, and you've got to have insurance before you have reinsurance. So, in a way, it's easier to be in this industry because you can follow the development in certain parts of the world as opposed to having to be out there leading it. But I think that it takes patience, and probably jumping in too soon into certain markets is going to cause some pain. Maybe the Thai floods was a good example of uncapped quota shares that got torched, and everybody had to rethink that approach in those types of markets where that's how kind of insurance to reinsurance develops, is ultimately initially through quota share, and so getting in there too soon in the wrong form caused pain for certain players in that market. And so doing it and being patient, kind of keeping your watching line, knowing what's going on in the market, being prepared to expand that quickly when that market does develop on the insurance and reinsurance side is important, but having the patience to wait for that is equally important.
Yeah. I mean, the thing is that you're right, because I think in order to get reinsurance, you need insurance, and you don't have insurance when, especially in those emerging markets where insurance penetration is so low. And so it's a question of, do you create the insurance demand, whether it's via mandatory insurance or not. But emerging markets are tough because on one hand you figure, if I'm an insurer, a global insurer, right, this is going to be probably one of my largest source of future growth. And if you think that about 20% of the worldwide insurance premium comes from emerging markets, roughly. The problem becomes one where you're chasing growth, and for some of them it's chasing diversification, right? Which I call it diversification, because you're actually not diversifying for the benefit of the company. And a lot of those emerging markets come with huge catastrophe risk, right? So that's the other question that you have to look at is, aside from just your attritional business, is whether you look at China, whether you look at India, whether you look at even some of the Latin American countries. I mean, Chile was a good example where they had a massive earthquake, and yet the rate on lines on Chile from a reinsurance perspective, you're going to have to wait 200 years before you're paid back on Chile. I mean, is it really worth it? If I'm a reinsurer, I'm like, hell, I'd rather write Florida any day of the week, because if the big one hits, I know my rates are going to go up. I hate to use the concept of payback, but it is a consideration. So the whole emerging market is and it's very difficult. I mean, look at for those of you that have tried to get into China or into India. I mean, those are tough market to get in, right? I mean, even Brazil, where the IRB is like sort of like making 2 steps forward, 5 steps backward. So you really don't know where you're standing in terms of the real opportunity there to be able to access the Brazilian market. So it's not as developed of a market. So to echo my fellow panelists, I guess we say that, or roundtablers, it's not an easy task. So it's really proceed with caution.
Thanks, Chris. Earlier in the conversation, you started discussing data analytics or risk analytics. There's been a lot of discussion in the financial services sector as a whole over the advancement of technology and data analysis. How important is it to reinsurers to advance their technology and to advance their data analytics, considering that reinsurance has always been a data-rich environment. And maybe what do you see as some of the tangible benefits that reinsurers are driving for in pursuing those goals?
Yeah, I think data is core. It's what we do. Mentioned before, it is the raw material. I think I was looking at something at one point and they were saying actuarial science should actually be called data science. And if you think about it, they're right. And we base a lot of decisions off of data. Actually, we actually base the company off of data if you really think about it. And not just data associated with taking underwriting risk, but also data associated with taking investment risk, data associated with even personnel and the people that we hire, right? So if you think about data itself, it's extremely core to our business in many, many ways. I think it's important for companies to invest in data and in analytics. We've recently announced the Montpelier Risk Institute, which is a facility that tries to organize with academia and governments to be able to better assess risk. And in so assessing risk, we're obviously assessing data and different types of data. We're looking at data associated with earthquakes, but not necessarily where earthquakes happen, also where they don't happen, which seems maybe a little bit straightforward, but there's a lot of work that goes with that. And we're also looking at flood, for example. We've talked a bit about flood. The problem with flood is there aren't any flood models. So everybody wants to do flood, but no one has a model to actually model flood. So, you know, now those are under development, and different companies some companies have proprietary flood models they've put together, some don't. But my real point here is that it is extremely important that there's a focus on analytics. I think it's really the underpinning of our business going forward. You know, whether we talk about you know, regulators and how they look at, you know, our business, they're certainly looking at our data themselves. Rating agencies look at our data. We look at our own data. We look at our clients' data. And you know, anything we can bring to the table that actually helps them assess their data will certainly allow them to better assess their own business. And you know, as a reinsurer, that's what we're trying to do. So I'm a big proponent of it. I think you know, certainly helps in underwriting. It certainly can help in trying to predict to some degree, you can say, the future. You know, I've certainly thought about, you know, how should we think about trying to incorporate predictive analysis into individualized clients? What would make a client who's actually writing a homeowner's portfolio actually better than another client who's writing a similar portfolio? And there are very subtle distinctions, but that may be a better use of our own capital going with one versus another. So there are a lot of component parts to it. We're at the very beginning stages of all of this. But you know, I think it's an investment that actually has to happen.
Yeah, agree. You know, it's something that we pretty much founded our company on was better data than had been seen previously, better use of that data. We have a 40-person research team that does nothing but that on day in, day out, and so we clearly believe that's critical. Kind of back to our earlier conversation about kind of how do you become important to the customer, and our ability to we're unique with kind of sitting at the top of the food chain as a reinsurer. The brokers see their slices of the market, but we see kind of all of the market, and so we're able to accumulate that data in a way that can help the clients. And if you want to make yourself important to a client, you take their program, their submission that they give to you, you analyze it, and you go back to them. You tell them something they didn't know about their own business. That is very powerful, and so it's not accumulating that data, but being able to turn that into something that's important to your customer is critical, and locks in that customer and said, I want that same information next year, and there's one of my reinsurers is able to give it to me. They're on the panel, and whatever lines they're asking for, they're getting because they're giving me information that is improving my underlying business.
Yeah, well, I have a confession to make. I'm an actuary, so I have a soft spot for data. But having said that, I think we need to differentiate between, use of data for insurance purposes versus reinsurance purposes. And the reason why I say that is, on the insurance side, it's quite difficult to deal with data knowledge. no matter how sophisticated you're going to be, no matter how much research you've done, no matter how much characteristic you have on properties or cars or type of workers, you have one natural limitation, and that's regulation. Right? At the end of the day, you could dream up the best pricing variable you want in the world. Right? If the regulator says, sorry, you can't use color of the car as a rating criteria, when statistically red cars usually have more accidents than others. I think there's, data is great, is the ability of what can you do with that data, right? And how you can base your business. So I'm going to start with insurance because, it gives you, well, for some countries, and let's be clear here, not all countries are created equal. I mean, if you think of, U.S. and Canada, who I think are probably on the more sophisticated end of the spectrum when it comes to data gathering and collection, Europe is trailing way, way far behind in terms of the sophistication of insurers. Regardless, I think there's a natural limitation as to what you can do in that data. On the reinsurance side, what's really interesting, and Jeff mentioned this, I remember way back when, when RenRe was probably one of the first, almost the one of 5 games in town in terms of cat reinsurers. I mean, and they've always been a very technical company. And I remember insurance client coming out and say, wow, they taught me stuff about my portfolio that I didn't know about. So agree with you, I think that's extremely, extremely powerful. But, I always caution data because data could be a great ally, but it also can be a great enemy. Because, at the end of the day, there's so much, when we talk about, significance from a statistical perspective, a lot of the loss variation cannot be explained by just the variables that you have. So, data could be a friend or foe, depending on what you do with it. So, but there's no doubt that, we're getting, I was talking to one of the reinsurers in Bermuda a couple of weeks ago, and the amount of information they have on specific locations is scary. Is scary. But it helps them. And I think that's where you're going to have the disparity, because you're going to get a reinsurer having information that they could use because they have a little more freedom in terms of what they could do with that information than the insurers, who are constrained by what they can use from a regulatory perspective. So it's a tough game.
I'd just say my only comment, and I agree, there are differences without a doubt. Just something for all of us to keep in mind. The models that were developed, there are a tremendous number of assumptions in every one of these models. The reason that there are assumptions is that we don't actually have data to get us to the right point to be able to actually know which way to go. So we make an assumption. The more data we have, the more information that we're able to understand, the less assumptions we actually have to incorporate into models. And therefore, models have the capability through this use of data to get better and better and better. And we actually need models for our business. And models, everybody has a different opinion about models. Personally, having them as an underpinning of the business is extremely important. Those that have the ability to understand them, those that have an ability to kind of think differently through the use of them, I think those are the companies that will actually continue to succeed in this type of market.
Well, fantastic. Well, thank you very much to each of you. That was your perspectives and insight have been excellent. Thank you very much.